Welcome to the video presentation about moving average convergence divergence and MACD histogram. Moving average convergence divergence or MACD was developed by Gerald Apple during the 1970s. MACD is a lagging indicator because it measures the difference between the two moving averages and becomes into a momentum oscillator as it fluctuates above and below the zero line. The indicator is unbounded, thus it is not useful for identifying overbought and oversold levels. MACD is computed by taking the difference between a security's 26-day period and 12-day period exponential moving averages of closing prices. On the next slide, I will show you how to enter the market using the two moving averages. For the duration of this presentation, I will use the default values of 12 and 26 days for the exponential moving averages. The 12-day EMA is the green line and the 26-day EMA is the red line. The 12-day EMA is the faster moving average and the 26-day is the slower moving average. A positive MACD denotes that the 12-day EMA is above the 26-day EMA, meaning market is bullish. On one hand, a negative MACD indicates that the 12-day EMA is below the 26-day EMA, meaning the market is about to go bearish. A 9-day EMA of MACD is also plotted on the chart to act as a trigger line for buy and sell signals. The purple line is the 9-day EMA and the blue line is the MACD. When the MACD moves above its 9-day EMA, a bullish crossover occurs. This means that the rate of change of the faster moving average is higher than the rate of change of the shorter moving average. Thus, positive momentum is increasing and this would indicate to be a bullish signal. When MACD moves below its 9-day EMA, a bearish crossover occurs which may indicate a downward trend in price. The rate of change of the shorter moving average is higher than the rate of change of the faster moving average. Thus, negative momentum is surging and this would indicate to be a bearish signal. Now I'm going to discuss what MACD histogram is. The moving average convergence divergence histogram or the MACD histogram was authored by Thomas Asprey in 1986. It is shown on the chart together with MACD indicator. The MACD histogram is plotted as a bar graph. It is the difference between the MACD and its signal line, which is the 9-day EMA, to predict MACD crossovers. When the MACD is above its 9-day EMA, the histogram is positive or above the zero line, which indicates that the market is bullish. When the MACD is below its 9-day EMA, the histogram is negative or below the zero line, which denotes a sell signal. What is divergence? Divergence is a trading pattern wherein the price of an asset and an indicator move in opposite directions. There are two types of divergence: positive divergence and negative divergence. Positive divergence happens when the price of an asset makes a new low while the indicator is surging upward. Negative divergence takes place when the price of an asset makes a new high and the indicator is moving downward. A positive divergence happens on this chart. Prices are moving lower lows while the MACD is forming a series of higher lows. This denotes that prices are about to go up. A negative divergence occurs on this chart. The indicator fails to move upward as the prices make new highs. This type of movement signals a downtrend afterwards. For the conclusion, there are times when MACD crosses the zero line, which is known as the center line. A widening histogram shows that the current trend may be getting stronger, while a narrowing histogram suggests that a crossover may be drawing near. However, the MACD histogram is a less reliable indicator as it may generate whipsaws or fake signals. Thus, it is advisable to use histogram in conjunction with other indicators.